learn with joy.
Hi, hello champions. Good morning. This is your CA Trilok. I'm doing well. I hope your preparation is going well. In this video, I'm going to discuss the concept called as the marginal costing versus absorption costing. If you understand, it's very simple concept. But if you don't understand, it's one of the very complicated topic, and many people will take it as a choice. No need to go for the choice. I'm telling you, I am here. I am acting as a solution for that choice option. I am telling you it's very simple concept, and I am making this video at the request of the Prasanna. Prasanna has requested me to solve question number 4A of model test paper 1, which is based on the marginal costing versus absorption costing. Before doing that question, let us understand the concept of marginal costing versus absorption costing, and then we'll do the question of study material, one question of the study material, and then we'll solve the question number 4A of the model test paper 1. Okay, now without wasting time, let us get into the concept called the marginal costing versus absorption costing. Marginal costing versus absorption costing. And one more thing, few people are requesting to download PDF which I am attaching to the video. For them, they require the access. So once you click on that, I'll approve the access so that you can download the material. Okay, now let us start with the concept called the marginal costing versus absorption costing. So please understand. First, what we need to understand here is, what is the purpose of the marginal costing? The purpose of the marginal costing is decision making. The main goal of the marginal costing system is decision making. When the purpose is decision making, we will classify the cost into variable cost and fixed cost. Please understand the difference between these two cost accounting systems happen because of the cost classification. In case of marginal costing, decision making is the purpose, so they classify the cost into variable cost and fixed cost. When it comes to absorption costing, the main purpose is stock valuation, profit calculation. So they classify the cost into manufacturing, administration, selling, and distribution. I can give you the examples. When it comes to the marginal costing, standard costing, budgetary control, all these stuffs are decision oriented. We will classify the cost into variable cost and fixed cost. When it comes to material costing, cost sheet, labor costing, absorption of overheads, all these things are related to stock valuation. So we will classify the cost into manufacturing, administration, selling, and distribution. Sir, how does it matter? Why you are discussing all this cost classification? Please understand. When it comes to marginal costing, stock will be valued. When it comes to marginal costing, stock will be valued using variable manufacturing cost. First of all, what you need to understand is stock means production units valuation. Stock means, don't think closing stock. It's about production valuation. The production valuation will be done. See, normally we know that units will be valued at manufacturing cost. Even in the financial accounting, you study the same thing. Units will be valued at manufacturing cost. Means production will be valued at manufacturing cost. But please understand, when it comes to marginal costing, stock is valued using variable manufacturing cost. When it comes to absorption costing, stock will be valued using total manufacturing cost. So this create the difference between marginal costing and absorption costing. Under marginal costing, we will be evaluating using variable manufacturing cost. Here it is total manufacturing cost. The gap is fixed manufacturing cost. The difference is fixed manufacturing cost. Fixed manufacturing cost will not be considered for stock valuation. Fixed manufacturing cost will be considered for stock valuation under absorption costing system. If it is considered for stock valuation, we'll be calling it as product cost. If it is not considered for stock valuation, we'll be calling it as period cost. As simple as such. It's all about production units valuation. In our concept, in our subject, in our syllabus, whatever they given is about valuation of the stock. Marginal costing, under marginal costing, stock is valued at variable manufacturing cost. Under absorption costing, stock is valued at total manufacturing cost. The difference is fixed manufacturing cost. So fixed manufacturing cost is not considered for stock valuation. So we will be classifying it as period cost under marginal costing. It will be considered for stock valuation. So that we will be calling it a product cost under absorption costing system. That is the only difference. Apart from that, there is one more reason. There is one more reason called as the under or over absorption. I already told you many times, under or over absorption concept is there only in cost accounting system, that too in absorption costing system. That too in absorption costing system. So, under or over absorption possible in the absorption costing system, whereas it is not possible in the marginal costing system. These are the two differences which create the difference between marginal costing and absorption costing. I mean, everything is ditto same. Simple. Number one, treatment of fixed manufacturing overheads and under or over absorption. Fixed manufacturing overheads will not be considered for stock valuation in marginal costing. It will be considered for stock valuation in the absorption costing. Under or over absorption concept will be there only in absorption costing. It will not be there in the marginal costing. That's it. As simple as it. Okay. Now look at here. Simple. When it comes to marginal costing, what is the format of income statement means? Listen to me carefully. First, we'll take sales. We all know the income statement. Sales minus variable cost will get contribution, minus fixed cost will get the profit. Understanding? Now, sales minus, instead of taking total, see, variable cost we can classify into variable manufacturing cost, variable non-manufacturing, or variable administration cost, variable selling cost, variable distribution cost. So what we are going to do, first we'll take only variable manufacturing cost. First we'll take only sales minus variable manufacturing cost, which is called as variable cost of goods sold. How to calculate cost of goods sold? Opening stock plus variable cost of production minus closing stock. Opening stock plus cost of production minus closing stock will get the cost of goods sold. Sales minus variable cost of goods sold, we given the name called as the gross contribution. Because sales minus total variable cost is contribution. But what we are reducing is only variable manufacturing cost in the name of variable cost of goods sold. So sales minus variable cost of goods sold will be called it as gross contribution. From the gross contribution, if you exclude variable administration, selling and distribution cost, will be calling it as contribution. Minus fixed cost. Fixed cost of manufacturing, administration, selling and distribution. Fixed cost of manufacturing, administration, selling and distribution will be calling it as profit. This is the format of income statement under marginal costing. When it comes to absorption costing, first we'll take sales. Sales minus cost of goods sold. How to calculate cost of goods sold? Opening stock plus cost of production minus closing stock will get cost of goods sold. We'll be calling it a gross profit. We all know that sales minus cost of goods sold is gross profit. Minus administration overheads minus selling and distribution overheads plus or minus under or over absorption. We'll be calling it as net profit. Please, I am repeating in every video. I am telling this because that's such a important concept, under or over absorption. I have made separate video on that. I have made separate video on that. Please revise that video once so that you get the full clarity on what is this under or over absorption. Okay, sales minus cost of goods sold, gross profit minus administration overhead, selling and distribution overhead, plus or minus under the over absorption will be getting the net profit. This is the profit under marginal costing. This is the profit under absorption costing. There will be a difference. The difference reason is only one thing: stock valuation. Here stock is valued using variable manufacturing cost. Here the stock is valued using total manufacturing cost. That is the only difference. Remember. The point which you need to remember is stock valuation. Under marginal costing, stock is valued at variable manufacturing cost. Under absorption costing, stock is valued at total manufacturing cost. Even under absorption is adjusted. The only difference is valuation of stock. Clear? Understood? I have clearly given the format of income statement. Look at here. I have clearly given the format of income statement. See, this is under the absorption costing. First sales minus cost of goods sold, gross profit, minus administration, selling overhead, under our absorption will get the net profit. Simple. We all know that sales minus cost of goods sold is, see, cost of goods sold format is opening stock plus cost of production minus closing stock. We know that sales minus cost of goods sold is gross profit minus administration overhead, selling and distribution overhead. Under our over absorption is the adjustment in absorption costing, and they will get the net profit. When it comes to marginal costing income statement, look at here. This is the marginal costing income statement. Sales minus variable cost of goods sold. I am not taking the total variable cost. I am taking variable manufacturing cost in the name of variable cost of goods sold. opening stock plus variable cost of production minus closing stock, we'll get variable cost of goods sold, we'll get the gross contribution, and then we'll reduce the variable administration, selling and distribution overhead, we'll get the contribution minus fixed cost, we'll get the profit. This is the format of the absorption costing and marginal costing. Simple. Are you understanding? Okay, now let's start doing the question based on this concept. Look at here. They given only one question in the study material. Let us understand the question first, then later we'll discuss about the solution. Listen to me carefully. XYZ Limited has a production capacity of 2 lakh units per year. Normal capacity utilization is reckoned as 90%. So what does it mean? The total production capacity of the given company is 2 lakh units, but normally means on average, how many units they can produce means 90%. Okay, 90% means 1,80,000. This 90% we can write it as 1,80,000 units. Okay, next. Standard variable production cost are 11 per unit, fixed cost 3,60,000 per year, variable selling, see they given production cost, selling cost. Administration cost is not given in the question, distribution cost is also not given in the question. They given only two things, production cost in the sense manufacturing cost and then selling cost. Production cost is 11 rupees per unit in the standard variable and fixed cost is 3,60,000 per year. Variable selling cost is 3 rupees per unit and fixed selling cost is 2,70,000 per year. The unit selling price is 20. We all know that manufacturing cost will be adjust or will be arrived based on manufacturing cost per unit. Manufacturing cost per unit will be arrived based on the production units. Selling cost per unit will be arrived using units sold. Our manufacturing cost will be recorded through production units. Other cost will be recorded through sale units. So why I am explaining this means this 11 unit depends upon production. This 3 unit depends upon sale units. Those 3 unit depends upon sale units. Okay, next. In the year just ended 31st March, the production was 1,60,000 units. Actually, this 1,80,000 is the normal capacity, nothing but budgeted capacity. Normal capacity is also called the budgeted capacity, whereas the actual capacity is 1,60,000. Actual capacity is 1,60,000. Okay, now. And sales were 1,50,000 units. Production is 1,60,000. Sales is 1,50,000. Closing inventory is 20,000 units. What is missing here? Opening stock is missing. Opening stock is missing. We all know that goods sold equal to opening stock plus production minus closing stock. If you use this formula, okay, let me substitute the values. Goods sold, how many units sold? 1,50,000 units sold. Opening stock is, we don't know, plus production is 1,60,000 minus closing stock is 20,000. We will be getting opening stock equal to 1,50,000 minus 1,40,000 is the net value. So we will be getting opening stock 10,000 units. Clear? Next. Last adjustment what they given is the actual variable production cost. See, look at the information. Actual variable production cost. Actual variable production cost is 35,000 higher than the standard. What is the standard given? 11 rupees per unit. 11 rupees per unit is the standard. Are you understanding? Standard cost is but permitted cost, allowed cost. But they are taking 35,000 extra. That is the actual cost. So allowed cost is 11 rupees per unit. How many units we are producing? How many units we are producing? 1,60,000 units. So 1,60,000 units into 11 rupees will get the standard variable cost permitted. Plus 35,000 will get the actual variable production cost. Are you understanding? Okay. Now look at here. They are asking profit as per absorption costing and marginal costing. Explain the difference. First, we'll do it under absorption costing. When it comes to absorption costing, listen to me carefully. Sales minus cost of goods sold. How to calculate cost of goods sold? Opening stock plus cost of production minus closing stock. Okay, now look at here. Sales is how many units sold? 1,50,000 units sold at the rate of 20. So 1,50,000 into 20, 30 lakhs. Look at here. 1,50,000 into 20, 30 lakh rupees. Okay. When it comes to opening stock, listen to me carefully. Just now I have given you the working also. Look at here. 10,000 units. Opening stock is 10,000 units into cost per unit under absorption costing. See, marginal costing is variable manufacturing cost valuation. Absorption costing is total manufacturing cost. When I say total manufacturing cost, variable plus fixed. Variable plus fixed. Okay, the variable standard cost given that can be taken as the actual cost. Variable standard cost given is C. 11 rupees. Using 11 rupees only, we are going to evaluate the opening stock. Why we are using standard cost? Why we are using standard cost? Please understand, under standard costing, there is a concept called the partial plan versus single plan versus partial plan. Valuation of material. Single plan versus partial plan. So what I mean to say, that one thing I'll discuss when I'm discussing the standard costing. As of now, what you need to understand is opening stock is valued at standard cost. Standard variable cost. Listen to me carefully. Standard variable cost is 11 rupees. Standard variable cost is 11 rupees, which I'm taking it as actual variable cost. Or else we can take it like this also. In the absence of information of actual variable cost, we are taking standard variable cost. Are you understanding? So standard variable cost is 11 rupees. I'm telling you again, this 11 rupees, why I'm taking means that is according to single plan concept. That variance of 35,000 would have been already accounted in the last year. No need to carry forward to current periods. So if they follow the single plan, total variance will be recorded in the total variance of purchase will be recorded in the same year. So the stock will be valued at standard cost. The closing stock will be valued at standard cost. Are you understanding? So last year closing stock is valued at standard cost. So current period opening stock will be valued at standard cost. Standard variable cost is 11 rupees. Now fixed cost. We need to calculate fixed cost per unit. How to calculate fixed cost per unit? Listen to me carefully. Total fixed cost is 3,60,000. We are under absorption costing system. Fixed manufacturing cost has to be absorbed. How to absorb? Using budgeted rate. Budgeted rate equal to budgeted fixed overhead divided by budgeted output. In this question, we are going to take the budgeted output as the base. Output as the base to absorb the fixed overheads. So which equal to budgeted fixed overheads is 3,60,000 divided by budgeted output is 1,80,000, which equals to 2 rupees per unit. 11 rupees per unit is the variable and 2 rupees per unit is the fixed. Total it come to 13. So that here we are taking 13. 10,000 into 13, 1,30,000. 10,000 into 13, 1,30,000. Now we need to calculate cost of production. How to calculate cost of production? Standard variable cost. Look at here. Cost of production. Standard variable production cost. 1,60,000 units into 11 rupees. We are getting total 17,60,000. Variable, they mentioned that it will be actually is more by 35,000. So I am adding 35,000. We will be getting actual variable production cost 17,95,000. To that we need to add the fixed overheads. Fixed overheads is 3,20,000. I'm absorbing the overheads. How to absorb the overheads? Actual base quantity into budgeted rate. Actual base quantity is 1,60,000. That is the actual production. Into budgeted rate is 2 rupees. So 3,20,000 totally come to 21,15,000 is the cost of production. Opening stock is already valued. Now the cost of production is 21,15,000. Closing stock we need to value according to the current year cost of production. Closing stock to be valued according to current year cost of production. Open stock will be valued according to last period cost of production. Closing stock of current year cost of production is 21,15,000 and the number of units produced is 1,60,000. So 21,15,000 divided by 1,60,000 into 20,000 units is the closing stock. We'll be getting 2,64,375 as the closing stock value. If you take the net amount 19,80,625, now gross profit is 30 lakhs minus 19,80,625, 10,90,375. We'll be getting gross profit. Administration overheads is 0. Selling overhead, there is a variable and fixed. Variable is 3 rupees per unit into number of units sold. We have to take number of units sold. Look at here, 1,50,000 units sold into 3 rupees and fixed cost is 2,70,000. Total comes to 7,20,000. I hope you understand till here. Okay, now absorbed overheads. When it comes to see under our over absorption, absorbed overheads is 3,20,000. Absorbed overheads is 3,20,000. Actual overheads is 3,60,000. There is under absorption, under accounted. Okay, now look at here. This is the absorbed overhead 3,20,000. Actual overheads is 3,60,000. In the absence of information, budgeted fixed overheads will be taken as actual fixed overhead. In this question, they given the budgeted fixed overheads. The same thing we are taking it as the actual fixed overheads. So 3,20,000 accounted, but actually how much you get? 3,60,000. Under accounted, under absorption. Now we need to account that. We are accounting the cost of 40,000. 3,20,000 accounted in place of 3,60,000. There is a under accounting. So now we are accounting 40,000 in the name of under accounting or under absorption. So look at here, under our over absorption of factory overhead, it's actually under absorption. It's under absorption 40,000. I written here under absorption 40,000 that we are accounting. So profit, how much we are getting? 2,59,375. Okay, now let us take the marginal costing. We all know that sales minus variable cost, contribution minus fixed cost, profit. But variable cost, we are going to take first variable manufacturing cost, and then we'll take the variable administration, selling and distribution cost. Okay, now look at here. Sales, I am taking 30 lakh rupees. Variable cost of goods sold. Opening stock of finished goods. Look at here. Look at here. Look at here. 10,000 units into 11 rupees I am taking. I am taking only variable cost. I am not taking fixed cost. Under marginal costing, stock is valued at variable manufacturing cost. Variable production cost is 11 rupees. So that 10,000 into 11 rupees, 1,10,000. And then variable cost of production. Look at here. In this working only we calculated actual variable cost of production 17,95,000. I am taking the same thing here, 17,95,000 variable. I am not taking total. And when it comes to fixed, see, on closing stock valuation based on variable cost of production, we are evaluating 17,95,000 divided by 1,60,000 units produced. We'll get variable cost of production per unit into 20,000 units, 2,24,375. If you take the net amount, it is 16,80,625, and the gross contribution is 13,90,375. Minus variable administration overhead 0, variable selling overhead, they given in the question 3 rupees per unit, 3 rupees into 1,50,000, 4,50,000, will get contribution 8,69,375. Now we have to reduce fixed manufacturing, administration, selling and distribution. Manufacturing is 3,60,000, administration is 0, and selling is 2,70,000, 6,30,000. So profit is 2,39,375. So the profit account to marginal costing is 2,39,375. Under absorption costing is 2,59,375. There is a difference of 20,000. The 20,000 gap is because of two reasons. One is because of under our over absorption, and one more is because of the stock valuation. Under our over absorption is already adjusted. Under our over absorption is already adjusted. Under our over absorption is already adjusted. That is not the reason. The only reason is stock valuation. The only reason is stock valuation. Look at here. Opening stock is shown 1,30,000, whereas here how much they accounted? Only 1,10,000 accounted. Opening stock is to be accounted 1,30,000, but what they accounted is only 1,10,000. There is an under accounting or under absorption or under valuation. Under valuation of opening stock in the marginal costing. Under valuation of opening stock in the marginal costing. Look at here. I will take profit account to absorption costing 2,59,375. 2,59,375. Opening stock is overvalued, or I can call it as opening stock is overvalued in the absorption. I mean, opening stock is showing more. Opening stock is showing more value in the absorption costing. When the opening stock value is more, we all know that profit is inverse proportion. If opening stock is inversely proportional to profit. If opening stock value is showing more, profit will be less. Now we need to add back. I'm repeating again. See here, opening stock value is 1,30,000 in the absorption costing system, whereas here in the marginal costing system 1,10,000. In which books it is more? Absorption costing system. So opening stock is more in absorption costing system. If opening stock is more, profit will be less. Opening stock is more means profit will be less. Are you understanding? I already told you closing stock is directly proportional to profit, whereas opening stock is inversely proportional to profit. If opening stock is showing more, profit will be less. Now what we need to do? By accounting 1,30,000, profit would have been decreased. Now we need to add back how much? 20,000 rupees. Look at here. Profit as per absorption costing system under valuation. Under valuation of opening stock in marginal costing. Under valuation of opening stock in marginal costing has to be added. Other way of writing is over valuation, but actually speaking, in absorption costing system, opening stock and closing stock is correctly valued at manufacturing cost, whereas in whereas in the marginal costing system, opening stock and closing stock is valued at variable manufacturing cost. So that I am calling it as under valuation of marginal costing system. Okay, now 20,000 rupees. 20,000 rupees. Next. When it comes to closing stock, here it is 2,64,375, whereas here it is 2,24,375. So closing stock we are showing more. Closing stock we are showing more by 40,000. Profit is also more by 40,000. Now what we need to do? So profit is showing more, 40,000. Now what we need to do? Reduce. We need to reduce that. Look at here. Minus Undervaluation. Undervaluation of closing stock in marginal costing system. Undervaluation of closing stock in marginal costing system 40,000. If you net off the 2,39,375. Are you understanding? So this is what about the study material question. Let us see the MTP. Let us see the MTP question. Question number 4A. Prasanna, this is for you. Now look at here. Simple question, but they're asking to do the same calculation for the 3 months. That is the tricky thing. Now look at here. AB Limited produces a single product B2 and sells it to a fixed price of 2050. So 2050 is the selling price. The production and sales data for the first quarter of the year 23-24 were as follows. April, sales in units 4,200, production units 4,600, May, June. They given the sale units and production units. Actual budget information for each month were as follows. This is for each month. This is for each month were as follows. Direct material 4 kilograms at rupees 120 per kilogram per unit. This is per unit. They missed this information. Here they mentioned that is for each month. But when it comes to direct material, direct labor, variable production overhead, these three things are related to per unit. That information is missing in the question. That information is missing in the question. Okay. Now, direct material is 4 kilograms at the rate of 120 per unit. So I can say direct material cost is 4 into 120 equals to 480 per unit. 480 per unit. Direct labor 6 hours at the rate of 60 rupees per hour. 6 into 60 rupees, 360 per unit. Variable production overhead is 150% of direct labor. So 360 into 150% will get the variable production overhead. Fixed production overhead is total is 5 lakh rupees per month. 5 lakh rupees per month. Fixed selling overhead is 95,000 per month. Okay, this is the information given. Next, there was no opening inventory at the start of the quarter. Super. At the starting of the quarter, opening stock is 0. That means for the month of April, opening stock is 0. Okay, now fixed production overheads are budgeted. Fixed production overheads are budgeted at 60 lakh rupees per annum. 60 lakh rupees per annum, and absorbed into products based on budgeted normal output of 60,000 units per annum. These two information is given per annum. Please understand, in absorption costing system, fixed manufacturing overheads will be absorbed using budgeted rate. What is the formula for budgeted rate? Budgeted rate equal to budgeted fixed production overheads. Budgeted fixed production overhead divided by budgeted output in this question. So budgeted fixed production overhead is 60 lakh rupees divided by 60,000 units, which equals to 100 rupees per unit. 100 rupees per unit. That is the absorption rate. Absorption rate. Are you following? Okay. Now what they're asking? Profit statement as per absorption costing principle, as per marginal costing principle, and then reconciliation. Reconciliation is only difference in opening stock and closing stock values. Let us start with the absorption costing system. We all know the sales minus cost of goods sold is gross profit minus admission selling overhead. Under our absorption adjustment, we'll be getting the net profit. Okay. Now let us take the absorption costing system. Look at here. First, I have taken direct material. First, I have taken direct material 4 kg into 120, 480. Direct labor 6 hours into 60, 360. Variable production overhead 360 into 150 540. This is the variable manufacturing cost. Using this we are going to use in the marginal costing system. This we are going to use in the marginal costing system for stock valuation. Using variable manufacturing cost only, we are going to evaluate in marginal costing system. For this, add the fixed production overheads. That is 60 lakh divided by 60,000. Just now I told you this is the budgeted rate. This is the budgeted rate. Using budgeted rate only, we need to absorb the overheads. The difference between absorption and actual is the under or over absorption. Okay, now, so 100 rupees is the fixed. Total manufacturing, this 1480 helps in the absorption costing system for stock valuation. Absorption costing system for stock valuation. Are you understanding? Now, before proceeding further, let us understand how many units are opening stock and how many units are closing stock. Look at here. So initially it is 0. Production is 4,600 in the April month and sales is 4,200 in the April month. Closing stock is 400. Closing stock is 400. The same closing stock will be coming as opening stock for the May. In the month of May, 4,400 units produced and sales is 4,500 units. Closing stock is 300. And the same 300 will be coming as the opening stock in the June month. Production is 5,500, sales is 5,200, closing stock is 600. So this is the opening stock and this is the closing stock. And this is the production. Okay, now let us start with the absorption costing system April month. Absorption costing system April month. Absorption costing April month. Sales 4,200, 2,050 rupees per unit will be getting 86 lakh 10,000. Opening stock is 0. Opening stock is 0. How many units produced? Will get the cost of production. Cost of production units. Full form is cost of production units. How many units produced? 4,600 units produced. We are under absorption costing system. Take the total manufacturing cost 1,480. So 4,600 into 1,480, 68 lakh 80, 68 lakh 8,000 minus closing stock. How many units lying as closing stock? 400 units will be into 1,480 per unit will be getting 5 lakh 92,000. Even if you take cost of production 68 lakh 8,000 divided by 4,600, you will get 1,480 only. Using the same 1,480, we are evaluating the closing stock. Opening stock is 0, production is 68 lakh 8,000, closing stock is 5 lakh 92,000, cost of goods sold is 62 lakh 16,000. Cost of goods sold is 62 lakh 16,000. Now gross profit is 23 lakh 94,000. Administration overheads in this question also 0. Selling overhead they give directly 95,000. Selling overheads is 95,000. Under our over absorption, we need to understand this. Listen to me carefully. 100 rupees, at the rate of 100 rupees, we are absorbing totally in the month of April. In the month of April, how many units produced? 4,600 units produced. So 4,600 into 100, 4,60,000 absorbed. 4,60,000 absorbed. Whereas, look at the question. Look at the question. Actual, see, actual and budget. Actual and budget both together comes to 5 lakh rupees per month. How much we need to account? 5 lakh rupees. According to absorption costing system, base quality consumed, nothing but actual production. Actual production 4,600 into budget rate is 100 rupees. How much we accounted? 4,60,000 accounted. But how much we need to account? We need to account 5 lakh rupees, but what we accounted is 4,60,000. There is an under accounting of 40,000. There is an under accounting of 40,000. Look at here. There is an under accounting of 40,000 that we are accounting now. So after that net amount is 22,59,000. That is for the month of April. In the month of May, again the same story. 4,500 is the sale units. 2,050, 92,25,000. Opening stock is last year closing stock will become opening stock. Last year closing stock will become opening stock. Production is 4,400 at the rate of 1,480, 65 lakh 12,000. Closing stock is 300. We all know that. Here it is. 300 is the closing stock. So 300 into 1,480 will be getting 66 lakh 60,000 as the cost of goods sold. Gross profit is 25 lakh 65,000. Administration overheads is 0. Selling overheads is 95,000. Now under our over absorption, how much is absorbed? Production is 4,400 into under 4 lakh 40,000 absorbed or accounted. 4 lakh 40,000 rupees has been absorbed or accounted. I have clearly written here. Look at here. 4 lakh 40,000 is the absorbed overhead. Actually is 5 lakh rupees. There is an under absorption of 60,000. There is an under absorption of 60,000. There is an under absorption of 60,000. Look at 60,000. Here it is. There is an under absorption of 60,000. Net amount is 24 lakh 10,000. Same way in the month of May. June. In the month of June, 5,200 into 2,050. Now opening stock is closing stock of last period will become opening stock, and production is 5,500 into 1,480, 81 lakh 40,000, and closing stock is 600 into 1,480, 8 lakh 88,000. Net amount is 76 lakh 96,000. So gross profit is 29 lakh 64,000, and selling overheads is 95,000. Over absorption. There is a over absorption. Look at here. Over. What do you mean by over absorption? Over accounted. Cost is over accounted. When the cost is over accounted, listen to me carefully. Cost is over accounted in this. When the cost is over accounted, profit would have been decreased. Now we are adding back. This is addition. This is an addition. Brackets I am putting to make classification as over. To identify, for the identification purpose, I put the brackets. It's a over absorption, over accounted. When the cost is over accounted, profit would have been decreased. When the cost is over accounted, profit would have been decreased. Now I am adding back. Whatever decreased, I am adding back. Adding back 50,000. So 29 lakh 64,000 minus 95,000 plus 50,000. You will be getting 29 lakh 19,000. Okay. Now, so this is about opening stock and closing stock. This is about under over absorption. Clear? When it comes to marginal costing, stock will be valued using 1380. When it comes to marginal costing, stock will be valued using 1380. Look at here. Sales is same. Sales is same as absorption costing. Variable cost of production. Look at it. 1380 we are taking. Everywhere we are taking 1380. Variable manufacturing cost. Because under marginal costing, stock will be valued using variable manufacturing cost. Okay, so 4,600 into 1,380, 63 lakh 48,000, 400 into 1,380, 5 lakh 52,000. The 5 lakh 52,000 will become opening stock for the May month. Okay, before that, look at here. We will be getting gross contribution 28 lakh 14,000 or contribution, because in this question there is no variable administration, variable selling and distribution. There is no such information in the question. So gross contribution will be equal to net contribution or contribution minus fixed cost. Fixed cost is 5,95,000. How they are getting 5,95,000? Manufacturing, administration, selling, and distribution. Look at here. Look at the question. Look at the question. Fixed cost is 5 lakh rupees production, 95,000 selling. Totally comes to 5 lakh 95,000. Totally comes to 5 lakh 95,000. Look at here. I have taken the same thing. 5,95,000 will be getting profit 22 lakh 19,000. Same way 92 lakh 25,000 closing stock will become opening stock 4,400 to 1,380 60 lakh 72,000. Closing stock is 4 lakh 14,000. Contribution is 60. This is the variable cost of goods sold. This is the variable cost of goods sold. This is the variable cost of goods sold. So 92 lakh 25,000 minus 62 lakh 10,000 will be in 30 lakh 15,000. Fixed cost is 5 lakh 95,000, 24 lakh 20,000. Okay, now June 1 crore 6 lakh 60,000. Closing stock will become opening stock 5,500 to 1,380. Closing stock is 600 to 1,380. Will be getting cost of variable cost of goods sold 71 lakh 76,000. Gross contribution or contribution 34 lakh 84,000. Fixed cost is 5 lakh 95,000. 28 lakh 89,000 is the profit. Now, so there is a difference in profit reconciliation. We have to do the reconciliation of profit under absorption costing and marginal costing. Profit as per absorption costing taken for all the 3 months. Okay, now absorption costing system. If you look at the absorption costing system, see marginal costing 0. Here it is also 0. Here it is also 0. When it comes to here it is valued 5 lakh 52,000. In absorption costing 5 lakh 92,000. There is an extra of 40,000. There is a gap of 40,000. There is a gap of 40,000. Here it is over. When the opening stock is more, automatically profit decreased. For the month of May, profit would have been decreased. Now we need to add back. Now we need to add back 40,000. Now we need to add back 40,000. So that I written addition under valuation of opening stock in marginal costing 40,000. Okay, same way here, same way in the June month. Opening stock is 4 lakh 14,000, whereas here it is 4 lakh 44,000, 30,000 extra. Because of showing opening stock more, profit would have been decreased by 30,000. Now I'm adding back. Now I'm adding back 30,000. When it comes to closing stock, understand first month, April. Closing stock is 5 lakh 52,000, whereas here 5 lakh 92,000. When the closing stock is shown more, profit would have been increased. By showing closing stock more, profit would have been increased. Now we need to decrease that, so that we are writing the less. So that we are writing in the less 40,000 rupees. So that we are writing in the less 40,000 rupees. Same way May month, June month. So these amounts has to be reduced and that amounts to be added. You will be getting profit according to marginal costing. Are you understanding? So I'm telling you again and again, whatever the questions that you have doubt, please mention me in the comment section, or you can approach me, directly on the Telegram number 90710685553. Anytime you can message me to this number. Anytime you can message me to this number. Definitely I'll respond to your doubts. Here the target is to complete the group 2 as well as group 1. Who are writing both the groups, we have to complete both the groups. Who are writing only group 2, target is to complete the group 2. Have a preparation. Whatever doubt that you have, please get back to me in costing and FM. In costing and FM, both the subjects, whatever doubt that you have, I'm ready to sort out that, and target is to get more than 80 in the cost accounting and more than 40 in the FM. Thank you.